the thing our session is about today is there's a slide there that I'll talk to in a minute, but one of the most critical aspects of managed accounts is obviously investment selection. And so a big enabler of that more recently has been technology, and that's been a big enabler of the range or the flexible or choices that are available in the listed investment space. And you can see here on this chart that at December 2010, there was about 5 billion in ETP, so exchange traded products on the ASX, and now that's pushing through 30 billion. So the sort of strong rise there you can see in exchange traded products, and that's been borne out largely through enhancements to technology in our industry. So just wanted to sort of talk you through that. So might just cross to our first question I have for Vinny, and you'd say, like, we talked about technological advancements and the impact they've had on our industry. Can you sort of talk through how that's enabled some of the investment solutions we see in this space and sort of the offerings that you may have in this space as well?
Sure, Chris, thanks. So look, technology is a big part of it, but there are also some others that I might touch on also. So when we talk about technology, well, we've already all talked about managed accounts today, about the enabler that is. And what managed accounts technology is allowing you to do, or the platform to do, is to invest in listed products. And the listed products can range from, anything from LICs, exchange traded products, some derivatives also, shares, a whole range. So it just opens up the ASX as the foundation for your investment universe. Look, the other side of it is that the stock exchanges around the world, including the ASX, Chris, have invested a lot in research and development of their own platforms. Here we are, the change of units or the change of ownership of assets only takes 2 days, T+2. A lot has been spent and built in trading and in settlement also. So you're really leveraging off the power of the world's stock exchanges too. Look, the other thing to mention here in terms of this growth of exchange traded products, I mean, technology is one thing, but the other two things I'll also add too is you can see on the bottom scale here, this is the number of exchange traded products. So you can see the choice for Australian investors, whether it's model portfolio managers that many are in the room here, or individual mum and dad investors. There's now a very wide range, and we'll talk about that in a moment. And the third thing I'll also add is regulatory change too. It's been my super and FOFA that we have an obligation now to look at lower costs, and most ETPs or several ETPs do offer investment returns at a low cost. And look, the other one, and you don't usually hear these two words in the same sentence, that is regulatory innovation. Sorry if there's anyone from ASIC here. And that is where the regulator has allowed the next evolution of exchange-traded products in exchange-traded managed funds or active ETFs. Probably a segue to you, Frank, given you were the pioneer.
Well, yeah, I mean, obviously technology is the enabler. Just before I go on though, are there any actuaries in the room? I just want to know, what are the chances of one person winning both draws? That's just uncanny. You'd think he'd redonate the redraw the second prize, but never mind. Bloody greedy thing. So yeah, technology is critical, and I just think, the primacy of the market really doesn't lie, and when you've got $3 trillion in ETFs globally, then who the hell wants to stand in front of a tsunami? So yeah, we jumped on board with our listed vehicles a couple of years ago.
And can you maybe just sort of talk us through the type of solution you have in that space and how you embarked on that? So what was some of the market feedback you got beforehand, and what's been the market feedback since in terms of the solution that you derived it?
Yeah. Well, can I just open up by saying the motivator was trying to solve for a client-related issue. Hands up, who's ever invested in a managed fund? Like, downloaded a 16-page application form, wet signature. If you're an SMSF, could you please supply a certified copy of your trust deed and all the anti-money laundering just to invest in a managed fund? So that was the problem. What's the solution? So in that case, we obviously looked at what the ETFs were doing globally, and that was kind of the primary motivator to find a solution for investors. The feedback was all the barriers. So whether it's regulatory, whether it's ASX listing rules, whether it's disclosure requirements, whether it's fee structures, whether it's transparency, we heard it all and we kind of bulldozed through, to be blunt. Hamish has got some good contacts out there. So we pulled aside the head of ASIC, we pulled aside the CEO of the ASX. We talked to them about the concept, the plan, what we were trying to solve for, and eventually got there in March 2 years ago with MGE. And here we are a couple of years later, and $850 million of FUM doesn't suggest we made a bad decision to go down that quoted, or what we can now call active ETFs. Yeah, so we can call them active ETFs now, which the regulator was anti us calling them when we first launched. So that was kind of the feedback at first. Obviously, since then, you know, and I remember the ASX had inquiries from all over the world saying, how the hell has this Magellan business been able to crack the nut and get active management with live pricing? So we're not talking about the M fund solution here. We're talking about live market making intraday listed on the ASX. So they had inquiries from Singapore, UK, US, China, had all inbound inquiries as to what we'd done to get this thing on the market.
Very good. And in terms of a segue to that, just sort of talk through we talked about the amount of listed options available in the space, and obviously bringing institutional-like exposures back to the retail space. So whether it be active or passive, whether it be smart beta, whether it be multi-factor or single-factor, country, region, sector, you name it. Effectively, the list is endless in terms of the options that are now available. Can you maybe talk us through what's enabled that growth in those different types of exposures and how technology's played a part in that?
Sure, Chris. So, look, really it comes down to using this very simple, highly regulated managed fund structure in innovative ways, and that's the innovation. Applying that fund structure and putting a whole, you know, the universe could be infinite here. Obviously, there's got to be relevance. Look, we at BetaShares have been pioneers in introducing new asset class exposures, alternative ways of indexing, currency hedging, things like that. And it's really important for everyone here, particularly those that are managing model portfolios. There's several, you know, highly regarded model portfolio managers here, those that do that internally. What that means for you, though, is that no matter what your investment beliefs in terms of model portfolio asset allocation construction, you now have the underlying exposures available. Whether you're, you know, SAA only, passive only, to SAA with dynamic or even an absolute return focus, there are exposures available to you. So there are building blocks available there. So that's really been, it's been taking that fund structure and innovating that, Chris, has been the driver.
Yep. Next question maybe for both of you to sort of chime in when you need to. But in terms of, obviously we talked about the enabling of, and the main benefit that I see from a listed perspective is things around transparency, flexibility around execution specifically, and then efficiency from the portfolio approach. Can you maybe talk through how that resonates with each of your offerings in terms of the experience you've seen or the feedback you've gotten from the market, and how that sort of feeds into how people are using these particular solutions?
So from the efficiency perspective, obviously the market making function is critical. So the fund makes the price, and obviously when you're investing in global equities, the majority of your securities, when our markets open, are not trading. So we can hit a hard NAV at 9:30 in the morning. That's an absolute reflection of the underlying value of the securities within the portfolio. Then obviously the variables during our trading day are whether we own any securities in our time zone, and B, obviously the currency. So it's less to do with the volume of purchases and redemptions versus the actual value that and the market that we make, the market price that we make. So efficiency, tick that box. Liquidity is obviously a consideration. The thing we kind of maybe don't score as well in, Chris, compared to the either the smart beta or the pure passive, is around the disclosure. And you would expect that with a 25 stock long only portfolio, that's kind of our IP. And if we were compelled to disclose the composition live into the market, then Frank and Vinny can set up Magellan 2, discount the price by half, and just simply replicate the portfolio live at an enormously discounted price. So our IP is obviously what's at stake here. So, you know, again, the price. And what we didn't want to do is offer an arbitrage opportunity, listed versus unlisted. At the end of the day, it's exactly the same model portfolio. Same fee structure, same portfolio, same composition, same exposures, you name it, just in a listed version versus the unlisted version. And to talk about the efficiency, you only have to look at the variable performance dispersion between the two. It is completely negligible. And it was probably a little bit higher when the fund was smaller, which was originally seeded with $50 million. So that probably provided some argument around performance dispersion. Now it's genuinely negligible.
And Vinny, do you want to touch on?
Chris, I'll just add, so apart from the benefits that you mentioned, I'll add two others. First one is price certainty and price discovery. So with price certainty, because the ETPs, I'll call them ETPs, Frank, without offending you, are priced real time based on the underlying. So you know the price that you're going to get entering and exiting the units. And secondly, look, just to touch on a previous point of that of choice, right? I mean, what's happening here with the ETPs is that, look, we call it the great democratisation of investing, where, you know, institutional grade strategies or strategies that were difficult to implement in your portfolio now become available in an ETP. Examples of that are like currency hedging, the short funds where you can hedge your portfolio, lock in profits without having to sell the underlying assets.
Very good. Maybe just to sort of turn our attention now to some of the more active type of ETF. We sort of mentioned a little bit before, but obviously different answers from each of you in terms of how you look at it. But Vinny's firm's more of an enabler of active management within the ETFs, as where Magellan's more a pioneer in that space in terms of what they've created. Can you maybe, Vinny, talk through how fund managers are coming to you potentially in terms of what they're asking or the troubles they're having in terms of doing it themselves? What are some of the pain points that they're sort of experiencing and why they would necessarily come to an outsourced provider from that perspective? And Frank, can you maybe just sort of talk to what you explored in that sort of period and how you sort of went through that?
You want me to go first, Vinny? So you can contradict me. So the...
I'm going to take your ideas.
So the experience we've had is... it's caused a lot of interest. We, from the start, were very happy to share our insights, the mechanics with other managers, whether they be domestic or global. Our view was that it was kind of the more the merrier. You know, we've talked about the enabler and technology and all the rest of it. You know, if we're swimming in a pool and we're the only fish, like, it's a big pool, but, you know, we kind of want some company. And so, hence, obviously, we've seen other managers bring their ETPs, their active ETFs, to market. We've seen multi-sector, we've seen K2 come out, we've seen Schroders come out with a solution as well. So, at the end of the day, the ASX is providing that technology platform that enables the active ETPs to flourish. And, you know, I mean, you opened up, Chris, by saying, you know, the starting point is about the investment integrity of the solution. Hooray. You know, what a great idea. So whether we got listed or unlisted, whether expensive or cheap or whatever, or passive or active or whatever, the starting point is, you know, does this manager deserve a spot in my model portfolio? If the answer is yes, then obviously further due diligence and further considerations are undertaken. But, you know, I just think the ASX is going to provide a terrific platform for advice solutions for many, many decades.
I won't disagree with you, Frank. That's well done. So Chris, look, this is really the next evolution now of exchange-traded products, active ETFs. We've seen it in the US. So I've got some stats here on the US market. It's close to 60 billion now in pure active ETFs. And we will see that evolution here in Australia. It started with Magellan. We partnered with IMAP Capital a little over a year ago to launch some of their highly regarded active strategies, and we're exploring some others also. But again, it comes back to what Frank said. There has to be, a role in a portfolio. The manager has to have been selected. But the advantage for the manager is that the strategy is now available on the ASX with all of those benefits we've talked about in terms of ETFs and ETPs. And it's available to the whole world. It's available directly to SMSF investors for the reasons Frank said. They don't have to fill out the forms and they can get direct access to it.
Yep. And just to follow up to that, is there a particular type of fund that's more better suited to the structure in terms of, does it have to be a mega cap fund, does it have to be a large cap fund versus a small cap fund? Does it really matter what type of fund it is or what type of asset class it's over?
Well, just as long as it's got a Magellan name in front of it. What else matters?
Look, it matters that the underlying securities are liquid and able to be priced, because then that price then feeds through to the ETF price. We can calculate the price on a real-time basis. And look, it doesn't just have to span across equities too. It spans across alternative assets, dynamic markets, and fixed income. A bulk of the assets here in the US have been active fixed income ETFs.
Another question I had, it's probably more born out of personal experience, but in terms of the choice being offered or available to advisors and their clients, in the past when I would have helped a firm with their investment solution, it would have been just purely looking at managed funds and then maybe direct stocks, and now the lines being blurred around what's available and what can be used. And what most firms generally start off with is maybe a managed fund portfolio or a completely opposite solution, which is a full direct solution. But now we're seeing firms meld somewhere in the middle, and that's because they're seeing benefits of each of the approaches being used together, where in the past you had to use one or the other because the solution didn't allow. Can you maybe just sort of talk to that, what you're seeing in terms of your clients, in terms of the melding together of those particular ways of building portfolios?
Yeah, well, and again, I think it was alluded to in an earlier session where, the direct global equities for most people and most administrators probably isn't there yet with regulatory requirements and account opening facilities and whatever else. So I just think in the space we're playing in, the global equity space, we kind of argue that the melding, as you say, is a function of necessity more than anything. If you're going to construct a portfolio that delivers to clients' needs, there's an interesting concept, delivering to clients' needs, then absolutely an active global equity slice or sleeve needs to be considered. And I think, in exactly the same way that an advisor will use a core and satellite style approach with, maybe passive as the core and tilts to global, tilts to sectors, tilts to small caps, tilts to direct equities. I just think it's that optionality, and all of a sudden we've got these, enormously wider range of building blocks that enable, most client solutions to be satisfied, and I just think that's part of the technology sort of advancement that was alluded to earlier. There are just more options out there. Whether they're all used and exercised or not's another thing. It's up to you guys at the end of the day. But for us, it's about a quality investment solution as part of a potential portfolio.
Cool. Yeah, anything to add, Vinny? No.
No, look, we see a very wide range of beliefs in terms of portfolio construction. There's a client of ours who uses he's a one-person advisor up in Brisbane who runs a momentum quant model using ETFs, and his performance is sensational, right? And all the way to, as I said, core satellite, where the core can be either passive or, highly regarded active managers.
I'd also argue that we're kind of form agnostic. So, hopefully not everyone in this room believes that traditional wraps and platforms are kind of dead and buried as a result of, some of the technology advancements, the building blocks that we're talking about. But we're completely agnostic. So, whether money comes to us on platform, off platform, self-directed, intermediated, model portfolios, managed to manager, you name it, listed, unlisted, we're kind of agnostic because at the end of the day, our role is to generate some decent returns for your clients. There's kind of a big full stop after that. Like, it doesn't really extend much further than knowing what our role is and what our stated objectives are, and you assess whether we're delivering or not.
Sold me, Frank. That was very powerful.
Was there any questions from the audience over here?
No tough ones though. Anybody got any easy questions they want to ask?
No? Do you guys want to add anything to finish off?
I'm happy to give my oratory on smart beta, Chris, if that's all right.
No, that's for another day.
And I just want to thank Toby and the IMAP team for putting the thing on. Obviously, there's interest. Obviously, there's momentum. We'd love to play in the space, and hence we're here waving the flag. Toby, do you have a question?
Well, I do, Frank. Thanks for asking. My question has to do with the point which both of you touched on, which has to do with real-time pricing in the exchange-listed products, where quite a lot of the underlying securities that are represented on ASX-listed, or that are represented on the ASX, some of those underlying securities are in fact in markets that are closed, and just whether you see a level of risk embedded in the ASX-listed version that doesn't exist in an NTA-priced unlisted.
Yeah, well, one would imagine, as you can visualise, it would be easier to make a market price when 95% of your portfolio is not trading. So there's no live price movement whilst the ASX is open. Having said that, the power of algorithms and the ability to monitor intraday share price movements, for argument's sake, in MICH, our infrastructure active ETF, there is an exposure to Aussie. So we stand in the market assessing the price, making the price based on the movement of the underlying securities. But it's obviously easier, Toby, doing it when most of the stuff offshore is closed and not trading.
And on the passive side, Toby, I mean, many exposures do trade 24 hours. Commodities, gold, futures. So we're able to use the prices of those to calculate the real-time NAV of several funds.
Got a question,
John?
Question for Michael or someone from the broking community. Maybe this is just from a sort of user point of view, we don't actually care often that much when it trades during the day. So maybe there needs to be some talking between the platform, ourselves, and election that you can, on the platform, when you can say, well, actually, it just trades first thing in the morning, or, because we don't actually need the intraday trading, I think. But we would like it to be a traded instrument.
Yeah, no, it's a fair point you raised, Jonathan, but I think, where these active ETPs, whatever you want to call them, add the value is to generate the sort of experience that a self-directed investor has when they're buying and selling other listed securities. And so, unlike M funds where the CHESS messaging system sends off an instruction to the registry, wait overnight, unit price gets struck, message comes back, versus the live pricing. Now, I agree with you. I mean, our analysts, for argument's sake, are looking at company valuations, for 10, 15, 20 years. Where's this company going to be valued in 10 years? Sort of thing. So to offer live 15-second pricing is kind of ridiculous to us as well, but we're trying to solve for a particular investor need. Yeah, we're not fussed about intraday either, but the market kind of expects that to happen. So known pricing is critical.
Another question in the front here.
I just wanted to add something here. So look, many platforms do trade on your behalf, and they do a VWAP over the day. But the other thing, Jonathan, also is that it's not a problem for anyone unless they want to get out on a certain day, right? Then it's important.
I'm interested in market making and the cost of that, and is that sort of borne out in the MER, or how is that taken into account?
Good question, Angela.
Thank you.
The fund absorbs the costs of the market making function. The fund is the market maker, and the fund, in the same way where you externalise the market maker to a Susquehanna or a Macquarie or whatever, the market maker takes on the risk associated with making the market, and the market maker can often make money from the spreads in making the prices, and can sometimes lose money in making those spreads as well. In our case, those gains and losses stay within the fund. So if it's a gain, the unit holder gets the benefit, it gets embedded in the price. If it's a loss, obviously it comes off as part of the cost when striking the price. So it's absorbed within the market-making function of the fund.
For active ETFs.
For active.
For passive ETFs, though, where there's an external market maker appointed, those market makers are incentivised by the ASX to provide tight spreads around the real-time NAV, and separately we have an agreement with the market maker to have agreed spreads also around the real-time NAV. Angela?
Can I just add, Angela, externalising the market-making function for us was not an option, simply because the market's got an issue with selective disclosure. So if we give the portfolio to an entity, then they basically know what's in the portfolio and they're kind of considered inside, and that was not an option, let alone and therefore the requirement to disclose externally. So we actually were kind of hamstrung a little bit in that we had to internalise the market making rather than provide it through selective. Provide the portfolio.
It was a regulatory requirement.
It was a regulatory requirement.
All right.
Hold on.
No other questions? No.
Thank you.